Hey everyone. In today's video, I'm going to discuss a growth stock that Wall Street thinks has 14% upside. I have a list of 38 analyst price targets according to Yahoo Finance. And of these 38 analysts, the average price target for this growth stock is $220. This growth stock is currently trading at $192. So you can see the upside from there. The range of estimates is pretty wide here. It's one of the widest ranges I've seen for any of the stocks in my coverage. You look at between these 38 analysts, there's one analyst who suggests this stock should be much lower at $140 per share, and there's one analyst who thinks it should be much higher at $255 per share. So a wide range of $105 separating analysts on this growth stock. Now, this is, having different opinions among analysts on Wall Street is common. Having this wide of a range is a little bit less common. The reason for this is that there's a lot of estimate and assumptions that go into these valuation models to determine how much a stock should be worth. And if you change one of those estimates, that could change your price target dramatically. So that's where you have this wide disparity, likely due to the change in assumptions. Now, if I look at the ratings on a scale of 1 to 5, with 5 being a sell and 1 being a strong buy, this stock is rated a 1.8. So very close to being a strong buy. It is a buy and approaching a strong buy. So Wall Street is certainly bullish on this growth stock. The growth stock is Palo Alto Networks. This is the stock that Wall Street is bullish on, the one that I have been discussing so far in this video. And if you've been following my channel, you will know that Palo Alto Networks was one of my top stock picks for 2023. It was in my top picks for 2023 in that video I released in January. So I did pick this stock for the year. It's already up nicely for the year. If you have bought the stock in January and held it until today, you will be up quite a bit. Now, should you buy it again? Let's look at that. Let's look at that in this video. That's what I'm going to cover here. So looking at revenue growth for Palo Alto Networks, 25.68% in its most recent quarter, and that has surprisingly held up well. It's held up well. I mean, it has decelerated a bit, but not dramatically, which is rare to see for, Palo Alto Networks is a cybersecurity stock, mostly selling its services to enterprises. And companies that have been selling services to enterprises have seen their revenue fall, decelerate, decrease, because enterprises are becoming more cautious. They're expecting a recession, so they're pulling back their spending. So Palo Alto's revenue growth here is impressive. Furthermore, if I look at Palo Alto's operating profit margin, it's moved higher since 2015 as revenue has grown. So turning positive 0.37% in its most recent quarter. But even if you look back all the way to 2015, you see a nice upward trend here. I love to see this when I'm looking at growth stocks. I love to see it. This is one of my favorite things to see when I'm investing in a growth stock. Revenue growing and profit margins expanding. And I also double check this metric with the cash flow from operations to sales. So this is a confirmation metric. After you look at profits moving in the right direction, you want to look at cash flows from operations also moving in the right direction, because you can have companies that generate profits but at the expense of cash flows, at the expense of cash flow, and it could be a red flag. It could be a red flag. Sometimes you'll have companies make questionable sales practices. that will boost sales and profits, but then you'll see it show up in lacking cash flow from operations. One example I give my students at university, so when I'm teaching finance, this is one example I like to share with my students. I give them this example. I say, are you willing to buy a 5-year-old iPhone for $1,000? And of course, nobody raises their hands, right? Why would you buy a 5-year-old iPhone for $1,000 when you could buy a brand new one for less than that price? And I say, okay, what if I change it? What if I ask you, how many of you would buy a 5-year-old iPhone for $1,000 if you only have to pay me if you make over $1 million this year? And then everybody looks around and everyone raises their hand, right? Because they say to themselves, well, if I don't make $1 million, I don't have to pay for this iPhone. I get the iPhone for free. And if I make $1 million, well, I'm not going to be too upset about overpaying for an iPhone. So now everybody changes their mind and they say, okay, I'll take that deal. I know that's an extreme example, but companies can do similar tactics where to boost their sales, they can offer those types of terms to their clients where they say, all right, buy our product and you don't have to pay us back for 9 months or 18 months, or buy our product and you only have to pay us back if you're able to resell it at a 20% higher margin. There are several instances of questionable practices that management can undertake to boost sales. And it will boost profits also. But then when you go to check with the cash flow from operations, you say, hey, wait a minute. Cash flow is not coming in the company. All I see is accounts receivable, right? Because when somebody owes you, it comes in as accounts receivable, and accounts receivable is not cash flow. So that's why I like to look at cash flow from operations. It, you know, if there's any red flags, it'll show up when cash flow from operations is different from where operating profit margin is. But we don't see that with Palo Alto. In fact, we see even better cash flow from operations rising very nicely all the way up to 46.21% in its most recent trailing 12 months. So really good financial metrics here for Palo Alto Networks. And you can start to see what attracted me to this stock and why I ranked this as one of my favorite stocks for 2023. Certainly you can see why Wall Street is bullish on this growth stock. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Finally, valuation. It's still not expensive, trading at a forward price to earnings of 41.52. When I recommended the stock here in January, look at where it was. I basically picked the bottom here when I recommended it at, it was at a forward price to earnings ratio of less than 32. This is where I recommended the stock. And it has since jumped, and now it's trading at a forward price to earnings of 41.5, which is still not prohibitively expensive when you look at all the positives in the business, but it's just not as good as it's not as good of a value as it was in January. All right, so thank you so much for watching. I really appreciate your viewership. That's all I've got for this video, but I really hope you'll tune in again for another one of my videos. And I've put on the end screen here that's popping up my top 20 stocks for 2023. Since I was talking so much about it, I thought you might want to check out that video. So it's popping up on your screen right now. Please click on it and watch that video till the end, and I'll see you over there.